By 2026, it is estimated that over 40% of the S&P 500's total gains will be generated by non-human trading agents speculating on energy prices. This means if you aren't investing in the infrastructure of AI, you are mathematically guaranteed to trail inflation. You will be running on a treadmill that's moving faster than you can sprint. But does this mean the game is rigged? Or is there a specific hidden backdoor for human investors to beat the machines? Inflation is trending at 2.7%. On the surface, that sounds boring, but in finance, boring is dangerous. You have to realize that 2.7% isn't a ceiling. It is the new baseline floor. We are living in a structurally more expensive world. Interest rates are cementing themselves between 3.5% and 3.75%. If you feel overwhelmed by the conflicting noise in the market right now, take a breath. You are not alone. That confusion is a feature, not a bug. The old rule of buy the whole market and wait, the passive bubble has burst. We are entering the era of algorithmic selection. So, how do we navigate this? We need to rebuild your investing strategy from the ground up, starting with the first of my 5 pillars for 2026. At first glance, the play for the AI era seems obvious, right? You buy tech stocks, you buy the chatbots. That is the trap. That is where the noise leads you. When we conduct a proper stock market analysis, looking deeper than the headlines, we see a massive physical bottleneck. You can write code overnight, but you cannot code a power plant into existence. We are moving from a digital economy to a kilowatt economy. Here is the twist. The price of electricity now dictates the price of stock buybacks. Therefore, my strategy involves an aggressive 40% allocation to the physical constraints of AI, nuclear energy, and copper. Why copper? Think of copper as the nervous system of the new economy. You cannot have a data center or a robot without massive amounts of it, and supply is critically low. The lesson here is simple. Stop chasing the software that consumes the power and start owning the power itself. This is fundamental analysis stripped down to its core, supply and demand. When you invest in uranium miners and small modular reactor developers, you are buying the only thing the tech giants cannot fake. They all need to plug into the wall. By owning the wall, you win regardless of which AI model wins the war. But to fully grasp this shift, we need to look at something that seems unrelated to energy, yet is critical for your wealth. We see retail sales trending low. The consumer is tapped out on gadgets and cars. If you are betting on the next smartphone, you are practicing value investing in a shrinking market. However, there is one thing people will never stop spending money on. One thing they will liquidate everything else to possess. Time. This is the longevity escape velocity portfolio. Forget the old idea of healthcare as a boring defensive sector for retirees. In 2026, the biggest consumer spend is biohacking. We are witnessing a massive transfer of wealth from aging boomers into the longevity sector. They are quite literally trading their money for more life. My strategy is to aggressively invest in mid-cap biotech firms using AI to speed up drug discovery. We are looking at next-gen GLP-1 agonists. If that sounds complex, just think of them as software updates for human metabolism. We are looking at CRISPR therapies that edit genetic errors like you edit a typo in a document. What does this mean for you? Stop viewing healthcare as safety. View it as high-growth tech. This sector is recession-proof because the demand is biological, not economical. By positioning yourself here, you align your wealth with the most primal human drive, the will to live. That is the ultimate form of value investing. But even with strong sectors, we face a macro risk that keeps investors up at night, the currency itself. With the US dollar index trending high, cash feels safe. It feels warm and fuzzy under your mattress. But that is a psychological trap. In 2026, relying solely on the dollar is risky due to mounting national debt. We need a passport for your money. This is the supply chain sovereignty hedge. My investing strategy allocates capital to physical commodities, gold and lithium, to hedge against currency debasement. But the real secret is where the rest goes. We target high-growth ETFs focused on the new factory floors: India, Vietnam, and Mexico. This is the trend of friend-shoring, moving supply chains away from rivals and into friendly nations. While Western retail sales are flat, these regions are seeing an explosion in GDP. By moving your capital there, you effectively short the stagnation of the West and go long on the industrialization of the South. Now, this global complexity sounds daunting. You might be saying, I can't track Vietnam's output and biotech trials at the same time. You are right, you can't. And neither can companies. That's why they are hiring machines. This leads to the robot tax portfolio. We have a chronic labor shortage. We simply don't have enough humans to do the work. The most profitable companies are those that replace human workers with machines. This sounds harsh, but as an analyst, my job is to help you separate emotion from execution. Don't just buy the software, buy the automation aristocrats. These are companies that lease humanoid robots to factories. Why? Because renting labor-saving hardware generates higher recurring revenue than selling software. It's not just a tool, it's replacement labor. Essentially, I am collecting a robot tax on every package shipped and every crop harvested by a machine. The takeaway? If labor is the bottleneck, own the solution. You are hedging your own human capital by owning the automated capital. Finally, as the world becomes more complex, the most valuable thing becomes safety. In 2026, the #1 threat to corporate earnings is AI-generated cyber attacks. We are seeing autonomous hacking swarms that can drain a bank in seconds. Most investors think cybersecurity is just antivirus software. That is a mistake. I concentrate my portfolio on defense contractors specializing in zero-trust architecture. Think of it this way. Traditional security checks your ID at the front door. Zero-trust checks your ID every time you try to open a cabinet, a file, or send an email. It trusts no one. As digital warfare escalates, these stocks become mandatory digital insurance. Companies cannot cut this budget. They pay it or they cease to exist. The lesson is to invest in the shield, not the sword. Let's bring this all back to where we started and conduct a final stock market analysis. I told you that 40% of gains would come from non-human agents. That statistic is terrifying if you are playing the old game. But if you look at the strategy we just built, the path is clear. We aren't fighting the machines, we are front-running them. We are buying the energy they need, nuclear. We are investing in the biology they are saving, longevity. And we are owning the security they require, quantum. We have moved from broad diversification to a strategy of concentration on scarcity pillars. This is fundamental analysis for the modern age. The average investor is exposed to inflation and outpaced by algorithms. But the investor who adopts this strategy is in a position of immense strength. Your greatest asset is agility. Your Achilles heel is nostalgia, holding onto the belief that the economy of the 2010s is coming back. It is not. The window to cross that divide is open right now, but as the algorithms get smarter, that window is closing fast. But I want to hear your take. If you could only pick one of these 5 pillars to hold for the next 10 years, energy, longevity, global industry, robots, or security, which one would it be and why? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.